Okay, this is the 7th and final video in the video tutorial series. Thank you for hanging in there up until this point. This last video corresponds to part 6 on your assignment document, and it corresponds to this last tab in your Excel file called the balance sheet. If you recall from your book, a balance sheet is a financial statement that reports the financial position of a firm by identifying and reporting the value of the firm's assets, liabilities, and owner's equity. So you can really think of it as a snapshot of your firm at a given point in time. And this particular balance sheet is going to be based on a lot of the decisions and information and values that you inputted in these prior tabs and the prior components of this assignment. There's actually nothing else that you need to be inputting in this particular portion of the Excel file. These yellow parts right here is just in reference to this note down here. Which is basically saying, again, for the simplicity of this assignment, all of these elements will be 0. So this is more an opportunity for you to really kind of get, a big picture view of your company. Hopefully be able to kind of understand a little bit what's going on, and perhaps just like you did hopefully in the income statement portion of this assignment is you can kind of interpret what's going on, and based on this you might want to go back into the earlier stages or earlier tabs and adjust your figures a little bit. That's really the benefit and the reason why we provided these Excel files that has the formulas embedded into them already. So it really gives you the opportunity to kind of manipulate the numbers a little bit and see how everything connects to one another, and hopefully it gives you an understanding of how certain decisions in terms of cost or sales figures impacts ultimately your profitability of your company. And so I'd encourage you to spend some time really in all the stages to really kind of get a feel for these different components and get a feel for how a certain decision might impact a certain component of your company in terms of its financials. And I think that'll really aid in your understanding of how this all goes into play in terms of the operations and management of a company, especially from a financial management standpoint. So with that said, in terms of the balance sheet, as the definition that I read to you just a moment ago referenced, is that it's made up of 3 main components. You have your assets, which you can kind of think of that broadly as this is what your company owns. It is anything of value of your company that can be, if not already, converted into cash. And you'll notice, this cash at the top, which, as I said, is definitely the most important asset of any company. Obviously doesn't need to be converted, it's already in that form. So those are the assets, and again, it's broken up into these different categories of long-term, short-term, and we don't necessarily want to get into the details of that. So you'll notice your cash right here of $8,224, as far as my example goes, corresponds exactly to this $8,224 that was on your cash flow statement. You've got your inventory right here, which corresponds to this inventory route right here. In theory, if you were to sell off that inventory tomorrow, then it would be converted into the $200 of cash. So that's where that kind of conversion goes into play. And then you have your assets of your your long-term assets, sorry. And these are a couple different categories of that, one of which is your equipment. If you notice that, if you remember back, I had made the decision of spending $1,000 on equipment. And so that would show up as something that the company owns in the assets category. And again, there's that same kind of rationale that if I were to sell that equipment, not factoring in the depreciation expense, theoretically I would be, getting that $1,000 of cash back. Hence, it falls into this assets category. Then this next category is your liabilities. You can think of this as something that your company owes instead of owns. It's something your company owns, or it's an obligation that your company has. And so here's where the liabilities are reflected for the particular company that I was demonstrating. It was in the form of a loan that I had made a decision to take out. Again, that $2,100 is right here under my loans. If I had made a decision to take out credit card debt, that would potentially be reflected right here as well. So right now my total liabilities is $2,100. The final component of the balance sheet is your equity. You could think of this as essentially your net worth of your company. So the way that I like to think of it at times is, if you were to sell your company tomorrow, what's left? What do you have left after you take care of all your debts and your obligations? And that's essentially what your equity is. It's that ownership into your company. And there's a couple different categories for the purpose of this assignment is your common stock. That's $3,000. If we go back to the cash flow, that was that initial amount of money that was invested into the company. So it's this $1,000 that was invested by the owners, and then the $2,000 by the investors. And then you also have that retained earnings. So if you remember back to the profit and loss, the profit and loss or the income statement, this was the decision here to retain or reinvest that $4,324 back into the company, which is adding to the net worth or the overall value of the company. So your total equity right here is $7,324. You notice down here is there's a breakdown of the equity in terms of how much the original owners own versus how much the investors own, and that is based on this percentage right here, based on the fact that the investors, like I talked about previously, essentially owns 2/3 of the company, based on how much money they've invested into it. So if you were to sell the company tomorrow and get rid of all of the debts, the value of the company that was left would be this $7,324, but $4,882 of that would go to investors because they own that 66% of the company, the way that this particular company was designed, versus the original owners only owned approximately 2,400. So that's something that's interesting to note on this sheet. One of the main questions that I've asked you to respond to as it relates to the write-up for part 6 of this assignment is whether or not your company has a positive or negative equity balance. What does this mean, and how can you improve it? And that how can you improve it question again gets to what I talked about before, is you don't have an opportunity to manipulate anything in here, but you do have an opportunity to potentially manipulate or adjust or re-go back to prior portions of this assignment and maybe adjust different aspects to perhaps raise your cash or lower your liabilities to ultimately increase your equity. But this is your equity value right here, is the 7324. And you'll notice this is a positive equity amount. If it was a negative equity amount, it would be displayed like this with the parentheses around it. And how we got this equity amount is we took the assets of 9,424 and we subtracted the liabilities, and that leaves you with the equity. And so that's that accounting equation that you learned about it in your book of equity equals assets minus liabilities. So it is a positive equity balance. And so I'm not going to necessarily talk about what that means. I'll leave that up to you in terms of for your interpretation as to what a positive or negative equity balance is, what it means, and how it can be improved if you how it can be improved. Since that is questions on your assignment, I'm not going to necessarily address that, but hopefully by now, if you understand what these numbers mean, where they came from, that should hopefully make sense to you right now in terms of what a positive versus a negative equity balance would mean. I also encourage you to reference the information in your book to help you answer that question. So that completes the video tutorials. So at this point in time, I just want to kind of recap what you'll need to do in terms of your final submission. So just like your other stages of your project, you just need to have one submission for your team. And for this, you'll need to submit 2 documents. You'll need to submit the completed Excel file. So with all of these components filled out, everywhere where there's a yellow, you'll need to have those numbers filled out, unless of course you don't take on, for instance, credit card debt, or you don't have some of these expenses, and that doesn't necessarily need to be filled out. And then you also don't need to worry about these areas right here. So you'll need a completed Excel file, so you need to save that, upload that to Moodle under the assignments link. And then you also need a completed report, just like you've submitted reports for your other assignments, that addresses those questions outlined on your assignment sheet, which essentially ask you to provide an overview and justify your decisions as it relates to these various tabs, as well as your break-even analysis. So you'll submit 2 separate documents. There's an option to submit 2 or upload up to 2 documents, files on Moodle, and that should take care of the requirements for this stage of your assignment. As always, if you have any questions or concerns, feel free to contact me, and I hope these video tutorials were helpful for you in working through the various components of this stage. And I apologize if they were a little too long, but I did want to make sure that I sufficiently covered all of the key points. So have a wonderful rest of your day or evening, depending on what time of day it is right now.